Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn.
Chicago wheat. There is an awful lot of information here in a very small patch of real estate, and that may be why the picture may appear sometimes a little clouded. Above the market, we now have the resistances formed from the gap from July 2021 between 657.5 to 615.5. That's been filled, but it's, the resistances formed around that, and a little higher up, the 50% absolute Fibonacci line at 682 even. We also have the small head and shoulders top neckline extension of the October to November 2020 pattern, currently 645 even. But to be honest, I don't think this is that important, this last piece is that important, other than perhaps reinforcing one of the other two resistances. 3 weeks ago, prices finally achieved the 609 target for the early November last year to early May this year, bearish halfway hesitation. My recent refreshed viewing of this market has highlighted two patterns that are currently running what's going on. Both are bearish. The first is highlighted in dark blue on my daily chart and is the early November 2022 to February 23 bearish Andrews pitchfork. The market has mainly been between the upper time above, currently at 631, and the middle time below, currently at 567, though the upper time has been breached, though not broken, on a couple of occasions. This has been especially evident when the additional overhead pressure of the declining short medium moving average, currently 669, separated from the upper time back in late March. This separation prompted me at the time to draw a second newer bearish pattern, a bear channel, currently 577 to 661 for the February to date action. This is especially significant given how the upper bear channel line had been in lockstep with the declining short medium moving average since late March. Needless to say, their combined bearish pressure would be greater than each individually. However, the short medium moving average is slowly peeling away from the upper bear channel line. It is still moving lower, just not at such a rate. And though these are not immediately threatened, it is worth noting that their capping pressure would as a result be less than when they were together. Finally, there is last week's action of a weekly key reversal down. This has not seen a follow through lower, nor to be honest higher either, but is still out there as an action and pattern, and ought not to be underestimated. So where does that leave us with respect to the downside? Well, the July 2021 low at 609 has been holding up the market up through May, though the downward pressure of the upper time means that by mid-June, so it's not that far away, by mid-June we will see one or other of these actually give way. At the moment, the July low looks the more vulnerable. Below this, we have the March 2021 low at 592, and beyond that, we have the lower bull channel line and the middle time, along with the December 2020 low at 566. Chicago corn. The obvious feature here is the huge gapping move lower made 2 weeks ago. The market has led lower prior to this move down, by earlier bearish patterns and actions, notably the true break below the back in late April, of the purple lower time, currently at 624.5, of the September 2021 to July 2022 bullish shift pitchfork. And that was, as I say, made in mid-April. This bullish shift pitchfork had until March this year never been tested on the downside, but the middle time above, that's actually up off the top of my daily chart, had managed to cap the market back in late September and October of last year. Hence, as I said 8 weeks ago, it deserved some respect. You see, it had earlier managed to hold up the market and stymied previous opportunities to reach the potential big bear flag target in the 490 zone. This from the potential February 2022 to date bear flag pattern. However, 4 weeks ago, the breach of the lower purple tone was not only a weekly key reversal down, but more importantly, also a monthly key reversal down for April. This, finally, was enough to set prices moving lower. The gapping action lower went straight through the 50% Fibonacci line of the April 2020 to April 22 move at 567, the July 2013 high at 564, the 2022 low at 562, the combination of the 2014 high and 61.8% Fibonacci line, absolute Fibonacci line at 525, and even the October 2021 low at 516. This showed the very effective vehemence of the move down. It was only congestion between 502 down to 491 with the 2021 low at 498 within it that finally halted decline. So what next? Well, there is some previous form in this market at holding at this 502 to 491 region, with the 2021 low at 498, which is backed up on the longer term charts for slowly rising 5-year moving average at 498.5. But we'll have to see how good this region is. Otherwise, well, we have congestion at 469 to 465 below, and at 449, 444, and 436 to 410 even. But the next big support is the 50% absolute Fibonacci line at 424, and that is quite a lot to swallow. So I've seen this week a move up to the lower end of the gap, but not as yet really try and fill it, with hesitancy in the rise, just below the combination of the 2014 high and the 61.8% absolute Fibonacci line at 525.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.